Bond markets crack first, stocks collapse second. That sequence is not theory, it is history. 3 decades ago, a sudden surge in yields shattered the global financial system with a speed no one saw coming. Portfolios evaporated, institutions broke, liquidity vanished, and the shockwave traveled so far that even the safest assets became dangerous to hold. Today, the same pressure is building again, yields rising faster than economies can absorb, governments rolling record debt into tightening markets, investors betting on stability while the foundation beneath them shifts. The charts that once signaled a historic rupture now glow with the same pattern. Quiet at first, then violent. The question is no longer whether the bond market matters. The question is how long it can hold before the break becomes unavoidable. Bond markets crack first, stocks collapse second. That is the sequence history keeps repeating. And to understand why, we have to start at the foundation of the financial world. Not the stock market that fills headlines, not the speculative excitement that people obsess over, but the quiet architecture beneath everything, the place where governments borrow, where banks anchor their balance sheets, where pension funds secure entire generations. The market that never trends on social media, yet decides the fate of every other chart. The bond market is not a sideshow. It is the system. It is the price of money itself. When yields rise, the cost of existence rises with them. Mortgages, corporate loans, government budgets, liquidity, confidence. Everything depends on stability in a market that most people never think about. For years, that stability looked unbreakable. Low rates acted like a protective shield. Governments refinanced effortlessly. Corporations borrowed cheaply. Investors treated government bonds as the safest asset on earth. And as long as yields stayed quiet, the entire financial machine moved smoothly. That silence was comforting, predictable, deceptive, because silence is not safety. Silence is pressure building out of sight. Now the pressure has returned. Inflation pushing upward, central banks tightening, liquidity draining from a system that depends on abundance. Governments carrying far more debt than they did in the past. Markets drifting away from the narratives built to reassure them. The same slow distortions that once preceded every major crisis have begun to appear again. Small at first, then sharper, then impossible to ignore. The bond market is beginning to whisper the same warnings it whispered decades ago. Yields rising faster than economies can adapt. Spreads widening between the strong and the fragile. Investors demanding compensation for risks that were once invisible. A structure built on cheap money, discovering what happens when cheap money disappears. This chapter reveals the truth most people overlook. Crises do not begin with panic. They begin with math, with pressure, with the slow bending of a system designed to function only when rates behave. The deeper diagnosis starts here, where the quiet market begins to signal the loudest danger. The first bond shock of the modern era did not arrive with warning sirens. It arrived with silence. Markets were calm. Investors were confident. Policymakers believed they were in control. And then, almost overnight, yields surged with a force no one had prepared for. The year was 1994, the moment when the system remembered that the price of money can change faster than anyone can react. Back then, the world was built on assumptions, that rates would rise slowly, that liquidity would remain abundant, that risk models were accurate. Traders built enormous positions on the belief that stability was permanent. Funds leveraged themselves on the expectation that a small move in yields would stay small. It was a comfortable illusion, a dangerous one. When yields jumped, the math turned violent. A move of a few percentage points erased billions in bond value. Portfolios that looked safe evaporated. Institutions discovered that they were far more exposed than their models had shown. Liquidity vanished. Selling triggered more selling. And the shockwave spread across continents with stunning speed. The world learned that when bonds break, everything tied to them bends with them. Scenes from that era still linger, like a warning. Traders staring at screens that no longer made sense. Governments scrambling to calm markets as borrowing costs shot higher. Pension funds watching decades of accumulated value collapse in days. A global system that had grown dependent on predictable yields suddenly faced the chaos of unpredictability. But the most important truth was psychological. People had convinced themselves that the rules had changed, that risk could be engineered away, that the system had matured beyond sudden rupture. The shock reminded them that the foundations of finance do not evolve with sentiment. They obey physics, not belief. And beneath it all was a pattern: mispriced risk, rapid policy shifts, overconfidence, liquidity drying up at the exact moment it was needed most. The same ingredients that once detonated the global bond market are reappearing now. The past is not returning as nostalgia. It is returning as structure. 3 decades have passed since the shock of 1994, yet the present moment feels uncannily familiar. The same quiet distortions, the same uneasy drift in yields, the same confidence mixed with denial. Only now the stakes are much larger. The debt is heavier, the world more interconnected, and the foundation far more fragile. For years, cheap money acted like gravity made gentle. Rates hovered near zero. Refinancing became routine. Governments expanded their obligations without fear. Banks loaded up on long-dated bonds, believing their value would remain steady. Pension funds built models on the assumption that volatility would stay low. The entire financial system grew dependent on a world that no longer exists. Then the shift began: inflation rising, central banks tightening, liquidity draining from markets that had forgotten what scarcity feels like. Yields accelerating faster than economies can adjust. Charts that once moved in predictable rhythms now spiking with unfamiliar volatility. And beneath it all, a simple truth: the system is waking up from a decade-long dream. Today's bond market behaves like a compressed spring. Every tick higher in yields adds pressure. Every drop in liquidity stretches the limits of what institutions can tolerate. Government budgets bend, bank balance sheets strain. Corporate borrowing becomes a hazard rather than a tool. Investors who once chased yield now chase safety. Confidence migrates, fear creeps in at the edges. The signals are not dramatic yet, they are subtle, but they are the same signals that appeared before previous ruptures. Spreads widening between strong and weak issuers. Volatility creeping into instruments that were once considered boring. Large institutions quietly adjusting positions, while retail investors remain unaware. A system shifting before the story changes. This chapter is not about predicting collapse. It is about recognizing structure. The warning signs precede the headline events. The market whispers before it screams. And the patterns developing now look less like random fluctuations and more like an old sequence reassembling itself. The bond market is not panicking. Not yet. But it is no longer calm. It is coiled, pressurized, waiting for the catalyst it cannot avoid forever. Every market has a threshold, a moment when stress stops spreading quietly and starts reshaping the entire structure. Today, the bond market is approaching that line again, not with noise, with pressure, with the slow tightening of conditions that once triggered some of the fastest collapses in financial history. The first fault line appears in leverage. Funds built on thin margins, strategies calibrated for stable yields, models that assume liquidity will always be there when needed. These positions thrive when markets behave. They implode when yields move too far, too fast. The same strategies that once amplified returns now amplify fragility. A single upward jolt can force selling. Forced selling forces more selling. Liquidity vanishes in real time. Then the strain reaches the banks. They sit on mountains of long-dated bonds whose value shrinks with every jump in yields. On paper, these losses look manageable. In reality, they weaken collateral, weaken trust, weaken liquidity. A bank does not need to fail to create damage. It only needs to look vulnerable. Because vulnerability spreads faster than insolvency. Doubt moves quicker than math. From there, the pressure moves into governments. Refinancing becomes painful. Debt that was cheap for a decade becomes a financial vice. What was a small increase in yields becomes a large increase in cost. Budgets tighten, deficits widen. The political room to maneuver disappears. Every new bond issuance becomes a test of market confidence. Every auction becomes a referendum on stability. And in this environment, the catalyst does not need to be dramatic. A missed target, a sudden downgrade, a liquidity mismatch in an obscure corner of the market, a policy mistake delivered at the wrong moment. None of these events cause a crisis on their own, but each one pushes a strained system closer to the edge. Each one tilts the balance toward rupture. The frightening truth is simple. The structure does not need a collapse to break. It only needs a spark. Because when the bond market moves, everything tied to it begins to bend. And once bending begins, breaking becomes a matter of sequence rather than surprise. The pressure point is here. The question now is not whether the system is stressed. It is whether it can hold. If the current pressure follows the same trajectory as 1994, the consequences will not stay inside the bond market. They never do, because the bond market is not a segment of the system. It is the spine. And when the spine flexes too far, the rest of the body loses balance. The first impact hits portfolios built on the illusion of stability: pension funds, insurance firms, banks anchored to long-dated government bonds. A sharp rise in yields translates instantly into evaporating value. What looks like a small move on a chart becomes a large hole in a balance sheet. Institutions that appear strong from the outside begin revealing internal strain. Liquidity disappears in places where it should flow easily. Then the pressure moves outward, into governments forced to borrow at higher and higher costs, into households facing rising mortgage rates, into corporations that rely on debt to finance growth. Bond market stress becomes real-world stress. It slows hiring, it kills investment, it forces choices that no one wants to make. The effects are slow at first, then they accelerate, then they dictate policy, and then the global layer begins to shift. Capital searches for safety. Currency markets react. Volatility spreads across continents that had nothing to do with the original spark. This is how a bond shock becomes a global event. Not through drama, through structure, through the invisible threads linking stability in one place to confidence everywhere else. But the story does not end in collapse. It ends in correction. Every major shock clears illusions that should not have existed. The dot-com crash revealed what was real technology and what was temporary hype. The Euro crisis exposed the difference between shared currency and shared risk. Bond shocks do the same. They strip away fantasies about permanent stability and remind the world that the price of money is the foundation, not the decoration. If this sequence repeats, the system will not vanish. It will change. Governments will be forced to confront the cost of endless borrowing. Banks will be pushed to strengthen their buffers. Markets will recalibrate around reality instead of hope. And the next phase of stability will emerge from the lessons learned in the breaking. The risk is real. The consequences are real. And the pattern is returning. If this gave you a new perspective, do not just scroll away, hit subscribe. This is Economic Chronicles, where history exposes the present and the future is written in the lessons we refuse to learn.